Chapter 4, Financial Forecasting. Developing pro forma statements is a fairly involved process. However, the rewards to you are high in terms of understanding the interaction of accounting data and financial forecasting. The development of pro forma financial statements is an integrative exercise, so there is little reward for a halfway approach. The use of an integrated Excel spreadsheet makes this process a little more manageable. It should be emphasized that any student intending to start your own small business will be required to prepare this type of a statement for a bank loan or a business plan. Often, our management students see no reason to master this painstaking exercise, but then they think they will be entrepreneurs one day, so it all makes sense. Take note that the percent of sales method presented at the back of this chapter is a second approach to financial forecasting. It is easily understood and quickly mastered, but it has many weaknesses and does not have the full validity of developing pro forma statements. So what will we learn in this chapter? We will learn that financial forecasting is the firm's strategic growth trajectory, that we will work with 3 financial statements. We will learn the percent of sales method. We will learn methods to determine the amount of new funds that may be required by the company in advance, and all of the factors that will affect cash flow. So financial forecasting is really about the ability to plan and make necessary adjustments, but before events occur, so it's preparatory work in nature, that the firm's outcome through external events involves a great deal of risk-taking desires and the firm's ability to hedge against risk with good planning. That there is no growth or decline, not primary cause of shortage of funds, or I should say not the primary cause of shortage of funds, and that a comprehensive financing plan must be developed for significant growth to happen. So how do we construct a pro forma statement? It involves establishing a sales projection that includes a forecast of economic conditions. It involves surveying sales personnel. You really need to understand that many of the numbers financial managers work with are provided by other functional areas of the firm, that the sales forecasts are usually generated by the marketing function, and projected sales for wheels and casters in Table 4-1 really was derived outside of the finance area. You'll note that Radio Shack was given as an example in that box in your text. We need to determine production needs and cost of goods sold and gross profits based on the sales forecast. Here's an example of the development of a pro forma statement that I'd like you to review and look at all of the steps involved and what the financial plans are or financial statements that are used. So we'll give you a second or two to take a look at this. The pro forma income statement provides the projection on anticipated profits over a subsequent period, but there are some very important steps. We need to establish that sales projection that we talked about earlier. We need to determine a production schedule that has to be associated with use of new materials, our direct labor, and any overhead to arrive at gross profit. We have to compute all of our other expenses, and we have to determine our profit by completing the actual pro forma statement. So we're looking at establishing a sales projection, assuming Goldman Corporation has two primary products, wheels and casters. So you'll notice from this graphic depiction, quantity, sales price, sales revenue, and a total. We have to determine our production schedule and gross profit. So we need to know the number of units produced, and that's dependent upon what we have in beginning inventory, sales projections, desired ending inventory. And then to determine the production requirements, we need to understand the units of production sales, of projected sales, desired ending inventory, minus our beginning inventory, and that equals our production requirement. Here's a view for Goldman Corporation of our stock of beginning inventory. And again, you see quantity, cost, total value, and total of wheels and casters. Here's our production requirements for 6 months. So we list out our projected unit sales, our desired ending inventory, we minus out our beginning inventory, and the result is our units to be produced. Our unit costs are the cost to produce each unit based on our materials, our labor, and our overhead. And our total production costs are illustrated by taking our units to be produced, our cost per unit, and determining our total cost. Our costs of goods sold are the costs associated with units sold during a time period. We have assumptions for illustration, which are based on FIFO accounting used, which is first in, first out. And it first allocates cost of current sales to beginning inventory, then goods manufactured during the period. There is an allocation of manufacturing cost in determination of cost of profits. If you could review this graphic, which leads us to our value of our ending inventory. So you see the beginning inventory that has a value, our total cost of production, our total inventory available to sales, which is the total of beginning inventory and total production cost, minus our cost of goods sold in our ending inventory. And I'll see you in the next lecture.